Okay, good morning, guys, or good evening, depending on where in the world you're watching this. But it's currently Monday, the 4th of November. So, Monday, fresh start to the market, new objectives. We actually started off this week perfectly with a nice win on pound yen this morning. So, I'm just going to be going through my thought process behind this trade, very similar to the last trade that we called out. You can check that out if you want, but yeah, let me just break it down for you. So hopefully some of you can adopt some of these theories. But yeah, like always, start off in higher time frames. So we don't need to worry about the monthlies anymore. We covered them in the last video. They haven't really changed. It's only been a few days. So the highest time frame that we're worried about at the minute is the daily. So like we mentioned before, we have our zone above price and our zone below price. So we're currently sitting on this level here, which was responsible for invalidating these various structures here, but we do have this area below price, which was actually the originator of this big up move, leaving lots of inbounds down here and actually invalidating these supply zones. So we would like to see a reaction from here. Ideally, what I'd like to see would be something like price to come down to here, have a reaction from there, mitigate from here a bit, travel up, have a reaction, and so on. But we will see how it goes. Obviously, this is just forecasting, just building bias. But yeah, so just from this, we have our bias as short from the daily. So breaking it down now in more detail, how we were actually able to get into this trade. As we can see, perfectly traded from 50 to 50. So the round psychological numbers again play a massive part in our thesis, but start from the beginning really, I guess, and build on the weekly template. So I'll get rid of these numbers there. There we go. You want to have them on when you're executing, but they're a bit of an eyesore when you're doing your analysis, basically. So how we actually came across that bias is through liquidity and the market maker's objectives, or the algorithm's objectives, however you want to describe it. So each week needs to be thought of as independent in itself. And what I mean by that is every week, so this line here signifies the beginning of the new week. From here from Monday till Friday, the market makers are going to have objectives, and they're going to need to hit those objectives and use retail liquidity and other banks' liquidity, various institutions' liquidity to get there. So every time we have a new week, we need to be aware of it, be aware of the weekly open price. This is critical. I'll go through that a bit more in some detail, but yeah, let me just break down what I mean by this weekly template. So this was the trade that went over in the last video. If you want to check that out, it's kind of just causing noise now. Let me I'll just get rid of it for now. Oh, there we go. So the weekly template we can see here. So we opened up here. We opened up high on Monday, last Monday. Obviously, I've gone through how we got into this trade and why our bias was short for the beginning of the week, but that was that. We then traded down one push, two push, three pushes into current weekly low, and then quickly reversed, trapping volume down here. So once we had this volume trapped down here, and it's trapped, remember, we have volume trapped above and volume trapped below. Volume trapped above because as price was pushing up on the hourly, like we covered in the last video, these wicks initially were big bullish candles, so retail were flooding into the market in longs before quickly reversing and trapping them. So whenever we see trapped volume, we can anticipate that price likely will not return to that point, because that would actually release those traders, and why would the market makers want to do that? So we have one push, two push, three pushes down, trapping volume below, and then we started consolidating. So we had a high, we had a low, and then we have a smaller range here. So like we mentioned in the last video again, we only want to trade once price has breached either the high or the low or the box. Whenever I say the box, I just mean the current high or low that we're trading in between. And price is always in a box, so it is important to be aware of this. It's in multiple boxes, so even while we're in trading between this range here, we're also trading within this high and this high here. So you could, if you wanted, mark out that high and that high. So we only want to take trades once price has either breached one of the sides of the box. We have our bias based on the higher time frames, but then we wait to see how price reacts outside of the box, at our timing windows, at psychological numbers, before actually placing our trade. So here, for instance, price is chopping up and down, comes up here, and we get a break below the box before quickly reversing and closing back into it. So this type of behavior is telling us that price has come out of this box. And remember now, retail traders are going to have their breakout orders, stop losses set below here. It's going to trigger them into the market before quickly reversing, and then this is our signal to go long. Followed by then 1 push, 2 push, 3 pushes to the high of the week. So this was the week's opening point. Again, this is a critical point in the market that you will want to start just marking on your chart, just having it there as a point of reference. You can see, if we're looking back at previous weeks, how crucial they are. Let me look at the hourly a bit better. Yeah, so guys, we can see here, these weekly opens, they become critical points just for future reference, because large institutions like banks and stuff are going to be having their higher time frame traders, so they're going to have their orders set at the closes and opens of the dailies, the weeklies, etc. So for instance, this weekly opened up here, and we can see on the next week it was actually used as resistance. This week opened up here, and it was then used as support, and so on. This week opened up here, and you can see it was perfectly used as resistance. And guys, when I'm talking about support and resistance here, I'm not talking about your traditional retail support and resistance. I'm talking about real support and resistance in terms of the psychological numbers, 50s, zeros. These are the real support and resistance, because this is where the large institutions will place their orders. So there we go. So we had our bias that was short for the week because of all this liquidity that was sat at these previous marks. Once that was taken out, where then is the next liquidity? I'm on the wrong time frame. So yeah, once these liquidities were taken out, where then is our next liquidities? It is above these highs. So we have a liquidity here, got another high. Oh, sorry, that's my mouse. Press the wrong button. There we go. So liquidity there, some more liquid sitting up here, and then again we have the weekly open there. So they all become points of interest and take profit targets. So the weekly opened up high, traveled down, taking this liquidity, ranged, stop on it out of the box, and then followed by 3, 1, 2, 3, followed by a 1, 2, 3. Into the weekly open, not releasing the trapped volume. If we whack on some numbers there, you can see, yeah, roughly at numbers. Followed by trapping the volume up here, creeping trend down, which then stopped these traders out, perfectly tag this supply zone before quickly falling down again. And then after these liquid points were invalidated, where is the next targets? These zones here. So we have this, we have this, and we have this low. All become targets. And we can see, yeah, they all got invalidated. So that's how we structure our weekly template, just based off of who is currently in profit and whoever is currently in profit, that is where price will likely travel. So just get rid of everything. We can see, guys, when price is traveling down, these session highs become our targets. Price goes up. Once price takes out these traders, the session swing lows because these guys are in profit. So whoever's in profit, that is the direction the price will likely travel to first, because no matter what your bias is or your thesis is, the market will always take care of current business first. And what I mean by that is that even if your bias is long or short, for instance, so while we were down here, our bias is short, but it has to take care of current business first, so it has to take out all of these profitable traders without releasing this volume here before traveling down. So it really is just a combination of building up, combining trapped volume, trapped traders with liquidity alongside the weekly template to get your your trade direction, basically. And all of this stuff, this all whether you're a market maker trader, BTMM, or supply and demand trader, smart money concepts, these concepts all tie in together and they all make sense. They all work together because they're all based off of the same theory. So for instance, this here, you could look at this as a supply zone. Perfect supply zone there. Back in a different color. So if you were looking to look at this supply zone, which caused breaks of structure, you're waiting for price to return to it to trade away from, that is the same as a market maker's 1 push, 2 push, 3 push down, level 3, 1 push, 2 push, 3 pushes up. These are all institutional types of trading. That's why they all coincide with each other and work hand in hand. But trying to incorporate them all will just do you no good. It will just fry your brain with too much information, which is kind of what happened to me. Well, not kind of, definitely what happened to me. I ended up trying to combine every institutional type of trading into one. And yes, I had a really good outlook on the market, but there was a lot of analysis paralysis there because I was trying to factor in so many different, just factor so many different indicators and different bits and bobs that it was just overload, just information overload. So now what I've been really working on is just simplifying my trading down and just working on the absolutes of the market, just the highs and lows, where's liquidity, where's trap volume, because this is where these are will tie in with how the market maker cycle works, and it will tie in with the major supply and demand zones. So we're just trading in the same way, but just looking at it at its core by doing this. And its core really is where the liquidity is, because where the money is where this market will go. So obviously then this major rundown was taking out all of this, clearing the board for the end of the week, and then we finish in consolidation. So like we mentioned in the last video, every session high, for those of you that don't know, these session colors, this is the Asian range, this is the London range, and this is New York. Every session puts in a high and puts in a low, and they either get invalidated or taken out in the future, and until they are targets, they are magnets. Price will be drawn to these because why? Traders have their stop losses and orders set above them. So we always want to mark out our range or our box that we're currently trading in between, and I'll go over that again in a future video. So feel free to hit that subscribe button if you want to be notified whenever we release those. But yeah, just for now, just know that price is always trading in a box, and we want to wait for price to either break the top side or the bottom side of that box before placing our trade. So how do we come onto this trade? Let me whack bang on the numbers just so we can get a clearer picture. So a lot of lines on my screen now, but what we just need to pay attention is this high and the low. So this was our range, this high and this low, coming out of New York. We're trading in between this low and this high, just consolidating, chopping. See these wicks, guys? Big candles up and down. This tells us that there's not a lot of institutional money in the market. There's not a lot of money in the market, so they can afford to move the market up and down loads because it's really cheap for them to move the market. Because again, yeah, there's not a lot of money sitting in there to stop them. So whenever we see this, just know that this is just an advertisement, just trying to suck in traders into markets, both in longs and shorts, just building up liquidity and then coiling in to then take them all out. And then what do? We go back into another range. So guys, when we see this ranging market coming into the start of the week, you should be licking your lips, just knowing there's going to be a beautiful trade. It doesn't matter what direction the trade comes in, because we have our targets. We know there's money above the market. We have got these highs here, these highs here. There's money above the market, and we also have money below the market. So we also have previous lows down here. So we know there's money in both directions, but we're not worried about which direction it's going to go. We simply just wait for them to show their hand and then trade accordingly. So we mark out our box, drop down to the 5 minute. So we have our major range, this high and this low, and then we have a range within a range. All sounds very complicated, but it really is simple stuff, guys. It's literally just a high and a low. So then we're trading in between the high and the low. Obviously this comes outside of it because these are just wicks on the 15-minute time frame. But as we can see here, waiting for price to breach one of the sides at round numbers, and we can see it comes up perfectly to the 153,250. So now we've breached the box at numbers, pinned above, tagged in all the institutional traders long, and then quickly reversed and closed here. This is all we need for our entry. And where do we take it down to? Either previous session lows or significant round numbers. So you can see how it perfectly traded in between the 50 and the 50, guys, and literally to the pip before, but yeah, just came down below, tagging in those institutional traders short, and then quickly jamming everybody back up again before consolidating again. So going forward now, what do we take from that? We've got a new high and a low to work with now. So we have this high and this high to work with. So we can actually get rid of these now. And this is what we're waiting for. So we're now not taking any trades until price either breaches down here to continue lower or up here to continue higher. Cool. That's pretty much it for this video. Hopefully some of the concepts can be of some value. I know a lot of this stuff might be new to you, so if you do have any questions, feel free to leave them down below in the comments. I'm sure there's not going to be an overload of information there, so I'll definitely be able to get back to you. Otherwise, got the free Telegram group, so feel free to join there, drop me a message on that, and I'll get back to you as well. But yeah, have a good rest of the week trading, guys, and I'll catch you soon.